So everybody has an opinion or two about the economy and what affects the economy and why, but few people really know. William A. Strauss is a senior economist and economic advisor in the Economic Research Department at the Federal Reserve Bank of Chicago. Bill joined the Federal Reserve Bank in 1982, and among other responsibilities, he produces a monthly Chicago Fed Midwest Manufacturing Index and organizes the bank's Economic Outlook Symposium and Automotive Outlook Symposium. Bill teaches or has taught as an adjunct faculty member at Loyola, at Webster University, at DePaul, and at the University of Chicago Graham School of General Studies, where he was named the winner in 2010 of the Excellence in Teaching Award in Business and Professional Programs. He's been interviewed on many national television and radio shows, quoted in major business publications, provided testimony to the U.S. Senate. He knows the economy, and believe it or not, he's an economist with a sense of humor, so which I think is hard to find. So please welcome Bill Strauss.
All right, thank you very much, Bob. All right, so we're set up here in a bowling alley setup. Those of you in the back of the room, I know you're legal eagles, but I'm not sure you all have eagle eyes. There is some open tables down here. For whatever reason you wanted to see the presentation a bit better, you're certainly welcome to move there. As Bob had mentioned, I teach. In fact, I got a class tonight right across the river at the Gleacher Center for University of Chicago. And one of my topics that I'll often talk about when we talk about economic growth is I will often tell people that bankruptcy is good. Unemployment is good. Not that we want to see these things. These are, all in all, evils of our economy and our society, with putting people and businesses through such turmoil. But they are necessary evils. Economies don't stay static. They are constantly evolving. Industries are rising, others declining. And it's these functions of unemployment, allowing firms to shed workers that are no longer needed, that make those workers available to those industries that are rising. And bankruptcy allows resources that might otherwise remain in industries or companies which are not doing very well to be reallocated into industries that are rising. So you guys certainly perform a very key function, greasing the wheels of our very vibrant economy. So what I want to do this afternoon is basically share with you my perspective with regard to how the economy is looking and how it's expected to perform over the next several years. It's a story of good news and bad news. The good news is, as we'll see when we kind of look around the world, with slow growth in Europe, expectations are, in fact, that growth is so slow, they're worried about deflation happening in Europe. Asia's growth is slowing. Growth in Latin America, South America should be doing better, but it's not. It appears that the U.S. economy is the strongest economy in the world. And that's the good news. But the fact is that our growth, even in this country, has not been impressive. And that's the bad news. That while we are growing, it is a growth rate that is, all in all, not doing very well. Now, we are in the start of the fourth quarter. We don't have third quarter GDP. As many of you are aware, GDP, the value of all final goods and services produced, gross domestic product, is our best measurement of overall economic activity taking place in the United States. And after having a decline in the first quarter, which can be attributed in large part to a bit of an inventory story, which would be considered transitory, as well as, of course, the crappy weather that we were dealing with all around the country. Nobody expected that to really remain at a decline going forward. And in fact, we saw a pretty good bounce in the second quarter, in large part making up for some of the challenges that were occurring in the first quarter. But similarly, we're not going to think that a 4% growth economy is what's likely to occur going forward, because a lot of that's just a bounce back. In fact, when you look at performance on a year-over-year basis, second quarter over second quarter, growth in the economy is at 2.6%. Often you'll hear all kinds of statistics about the growth of an economy, and it harkens back to that famous quote from Benjamin Disraeli, British Prime Minister from the 1800s, who talked about the three types of lies, right? You've got your lies, damn lies, and the worst, of course, is statistics. And it is, we are constantly, especially when the election cycle comes around, being bombarded with all kinds of statistics which are cutting and slicing the data to present whatever point they're trying to make, and not being all in all honest about it. That's one of the joys I have at working at the Fed. We're here to be the honest broker. I don't need you to buy into my stock. I don't need you to sell you anything. I don't want you to vote for my candidate. That's not what we're about. So we try to really think about how the economy is performing, and it's true. Growth, 2.6%, we're growing. But the metric is not zero that we should measure against. We shouldn't just be happy that the economy is rising rather than falling. In fact, the U.S. economy should be growing. By how much? Our estimates are somewhere around 2 to 2.25%. This is not a number which is just grabbed out of the air. It comes off of thinking about the only ways that any economy in the world can grow. Two ways. Labor force growth, more hands that do the work can produce more goods and services. So our labor force is one of the few in the developing world where we have population that's rising, growing by about 1%, half from native-born, half from immigration. So each year we can produce 1% more goods and services. But the other function that allows an economy to grow, and in fact is more directly related to improved standards of living, is productivity. The ability of doing more with less, doing things more efficiently. That's regarded as something around 1 to 1.25% in the U.S. So those two factors combined says that the trend growth, or what we should be able to accomplish just being the United States year in and year out, at least in the near future, is about 2 to 2.25%. Over the past year, we exceeded that, but again, by not very much. One sector which has been a real headwind to growth has been the housing sector. It's certainly improved from the collapse that took place, and this is a chart here showing the decline in real home prices, and it fell by 40% nationally. Of course, some states, probably where some of you are from, the Sand States, Arizona, Nevada, California, Florida, saw declines in excess of that in real terms. But those states are also seeing some of the best recoveries in prices. So it's a bit of that tennis ball bounce that one would expect. And we have seen double-digit growth in home values, and that's been helpful in terms of assisting consumers who are underwater with regard to their mortgages. But still, even today, around 15 to 20% of households who have a mortgage are underwater with their homes versus their mortgage. But prices have come up, and in fact, they've risen. But the point is that you'd have to go back 10 years ago to see equivalent prices in real terms. So I don't think that it's anything to get worried about that these prices are rising to such a high level. I think we still have a ways to go. In fact, the Blue Chip Forecasting Group, Blue Chip is this organization that has about 50 people participating, some top flight economists from around the country, and each month they submit their forecast to Blue Chip, and Blue Chip will analyze who's the best forecaster. So that's kind of the value that people get out of participating, is they get a chance to be recognized if they happen to hit the bullseye a particular year. But this is the forecast from the Blue Chip organization for housing starts. This year about 1 million, next year about 1.2. We think trend is about 1.4 to 1.5 million. So the housing market is still recovering. It's expected to operate below its trend for next year. And, you know, we should be putting in 1.4 to 1.5 million housing starts, in large part because of the growth of the population. You know, with 1% population growth, we have over 300 million people in this country. We're adding 3 million people every year. You got to house them somewhere. So that's where you come up with that roughly 1.4 to 1.5. Of course, one of the challenges has been what has happened with household formation, young people not leaving their parents' home, or parents living with the kids after losing their house quite a few years ago, or perhaps if kids are going out and starting get on their own, they're doing it with a roommate. So we're kind of becoming a bit of the Three's Company type of economy. The stock market has also shown some improvement. Now, many of you, again, will think that, wow, you know, stock market's at a record high. Not if you adjust for inflation. Keep in mind that the S&P 500 is a dollar index, and that a dollar today is not equivalent to what it was in the past. And when you adjust for inflation, it's actually, again, it's absolutely moved up, and it's helped out people's retirement plans. They look at their 401ks. They're feeling much better about the situation. But, you know, all in all, this market has just, with a lot of volatility, gone nowhere over the last 15 years. So what is the forecast for the economy? So I understand that some of you, especially if you're on the attorney side of the bankruptcy, might be hoping that I'm going to talk about a lousy economy and things going down. That's not the forecast, although the forecast is again, not for a great economy, not for our economy, which is going to be ripping and roaring. So I still think many of you will find quite a bit of activity over the next several years. The forecast from Blue Chip is for the economy's growth this year to come in at around 2%. That's taken into account the drop in the first quarter, the big gain in the second quarter. But as you can see in the green bars there, for those of you who can see them, pretty flat growth that will continue. Next year, growth of about 2.9%. So better than trend growth next year, which is good, but not incredible. It's just kind of decent growth. What is the Fed thinking? Well, 4 times a year, the Fed does what's called SEP, Summary of Economic Projections, from the policymakers who make up the Federal Open Market Committee. Those of you remember your Fed Foundation studies. We have the 7 governors in Washington. Only 5 right now in a position because it's a political appointment, and the politics are keeping 2 from being appointed or even nominated. We don't have not even nominations for the 2 available seats. But we do have the other 12 presidents of the 12 reserve banks. And in fact, Jeff Lacker will be speaking to this conference tomorrow. Anyway, this is their outlook for GDP. And as you can see, it's not too dissimilar for this year and next year from Blue Chip. And I promise you they didn't crib off of the Blue Chip forecast. It's just kind of what everybody's been thinking, and it's all in all fairly reasonable. Growth of around 2% this year, just under 3% next year. And then the Fed goes out longer than Blue Chip. And the reason for that is that monetary policy has quite long lags. And we have to be thinking about not just what 2015 is looking like, but 2016 as well as 2017. In fact, at our next policy meeting, whatever's decided there, given the kind of lags that we operate with, probably won't have an impact on the economy until maybe as late as the middle of next year. So basically, the first half of 2015, from a monetary policy standpoint, might be considered to be pretty well, baked in the cake. And it is what it is. So we have to be forward-looking. You can see 2016, that growth remains close to 3%. But the disappointing fact is that 2017, policymakers believe that the growth rates will slow closer to trend. Now, I say disappointing because some of you might be under the impression that, we've been challenged with all these headwinds of late, trying to get the financial markets back into balance, trying to get the housing market back together, trying to get the job market functioning better. But if we can just get past all of that, we can get this economy growing at a much more rapid pace, something like a 4 or 5% growth rate. Well, Fed policymakers just don't see that as a possibility or as a likely outcome over the next 3 years, so a bit disappointing there. Let me show you what typically would have happened for a deep recession. This graph here, what I've taken is the deep recessions of both the early 80s and the mid-70s when the U.S. economy fell by about 3%. And what you can see as I indexed right here, where they all intersect, the trough quarter to be equal to 100. And then I went out 20 quarters, 5 years, which is the length of the current expansion, which is in blue. But what you could see is for both the early 80s and the mid-70s, the economy in that 5-year period, the economic pie increased by 20 to 25%. That's a huge increase in just 5 years. That translates out into a 5% and 4.3% annualized growth rate. And back then, we thought the trend rate was around 3%. So we exceeded trend each and every year by more than a percentage point, as much as maybe 2 percentage points above trend every year for 5 years. That is how you remove slack out of the economy. That is how you give all those people who lost their jobs an opportunity to be reemployed. All the factories that are not producing material, giving opportunities for them to produce more. When you look at the current cycle, it certainly has gone up, and it's true that today we are producing more in the United States than ever before. But when you look at this 5-year period, after seeing a decline in excess of 4%, and that's why we call it the Great Recession. Output fell by a greater amount than at any other time since the Great Depression. Fell by 4%, but even that isn't all of the slack that was created, because the recession was the longest lived recession since the 1930s, lasting 18 months, December of 07, June of 09. During that 18-month period, we went down by more than 4%, but we should have gone up. Let's call it a 2% annualized growth rate. We should be 3% higher at that point. So the gap that we created was actually in excess of 7%. What we've done over the past 5 years, annualized growth rate of 2.2%. So after declining by that amount, all we've done is grow at a rate that the U.S. should normally grow at. That says that there still should be large amounts of slack in the economy. And I don't think you need to look further. I'll get to my further point in a second. This is very difficult, and I should have mentioned these slides will be made available up on the website, so you can kind of peruse all these individual slides. This is the blue chip international forecast, and what you'll find out of that is not a very good story for world economic growth. For example, the outlook for Japan, 1.2% this year, 1.3% next year. That's our third largest economy in the world. Eurozone, 1% growth this year, 1.5% next year. Even China's growth is slowing. Brazil, 0.7% this year, 1.4% next year. Russia, with all the challenges they're going through, basically no growth this year and just a little over 1% growth next year. So again, it looks like the U.S. is the strongest economy in the world. But in order for us to do well, we need the rest of the world to also do well, because we export a lot. And if these countries aren't generating a lot of income, then they're not going to be able to buy as many goods from the United States. I had mentioned about the slack in the economy. You don't need to look any further than the labor markets to see this slack. Again, I can lie with statistics and claim that we have more people working in the United States than ever before. Absolutely true, but absolutely meaningless from my standpoint. So in May of this year, we achieved recovering all the 8.7 million jobs that were lost during the Great Recession, which would be fine if labor force growth was 0%. It's not. With a 1% growth rate of our labor force, we are adding over 1 million workers each and every year. Previous peak was in early 2008, so we've got 2008, 9, 10, 11, 12, 13, 14. 7 years, 6.5 years worth of job that we need to add. That's about 7-8 million jobs that we're still short. But you look at the unemployment rate. Unemployment rate has fallen down to 5.9%. We think the natural rate is probably around 5.25% to 5.5%. Chicago Fed view closer to 5.25%. So we're let's call that a little over 0.5% away from being at the natural rate. Sounds like we're awfully close, that we should be celebrating. But the unemployment rate is not a great indicator for the health of the labor market. And I'll go through why some of the challenges of just highlighting this statistic. By the way, every percentage point, doesn't sound like a lot, represents 2.5 million workers given the size of our population. So the fact that we're more than 0.5 percentage point away from the natural rate says that this number here represents still over 1 million workers that we need to create jobs for. Labor force participation rate, many of you know that that has fallen quite significantly. Levels that we had last seen in 1978. In fact, it's fallen by more than 3 percentage points since the Great Recession. Now, I can lie to you and say that's all attributable to the economy, but it's not. As you can see, this line here has been falling going back to 2000. Why? We're an aging workforce. Participation rates decline as people get older. People retire. And so the decline of 3 percentage points, National Bureau of Economic Research has done some analysis that suggests that it could be as much as 2/3 can be explained by just demographics, and maybe maybe half of it could be. So I'd say between 1 to 1.5 percentage points is 1.5 to 2 percentage points are demographic, and therefore about 1 to 1.5% is still cyclical. This is representative of people who are no longer actively looking for work. And if they're not looking for work, they are not considered unemployed. And that's another reason why the unemployment rate has fallen, is that we have about, again, let's call it 1.5%, let's pick the midpoint, 1.25%. We have about 3.5 million workers who have just given up looking for work that otherwise would normally be engaged in the workforce. Add that to the unemployed number that I gave you before, and now we're up to about 4.5 million workers. And here you can see what should worry us as a nation, and I was having a nice talk with Tony about some of these issues, because when you break it out by age cohort, what you can see, I know it gets hard to see back there, but these top 3 lines look pretty flat, don't they? Those are your key working age segments, 25 to 55 years of age. So broken out by decennial ranges. The blue line here has actually been edging higher, although a little more flat of late. That's the 55 to 64. So in fact, there's been no decline in those individuals 25 to 64. And if you look beyond that, 65 to 69, 70 to 74, 75, yes, those lines are lower, but actually they've been rising over time. So where is the decline happening? Well, if it's not happening in anybody over the age of 25, it has to be focused on the youth. And when you look at what's been happening to the red line here, 20 to 24, hopefully these kids are going to college, so they're therefore not participating in the workforce, and hopefully getting a good education that will be valuable in the workforce. But if not, if they're just not participating because of lack of opportunities, that's going to be a real problem for us. And then you look at the teenagers, 16 to 19-year-olds. Their participation rate is about 1/3. And yet, as an aside, a personal view, we're pushing all these minimum wage laws, right? These are unskilled workers, these teenagers. You raise the price of anything, you don't get more of it demanded. Basic Economics 101. The other fact is, and this is again why we could be a little bit concerned about the labor market still having quite a bit of stress, is the percentage of the pool of unemployed workers who have been unemployed for more than 6 months. Yes, it has come down, although I would say it was partially brought up from those workers who were enjoying the 2 years of unemployment insurance by claiming to be looking for work, while probably many of those, or quite a few of those people, probably had already planned on not looking for work. For example, somebody who was 60 years old during the Great Recession, lost their job, and they're saying, I was going to retire in a couple of years. It's just not worth looking for work, so we can probably tighten the belt a little bit, maybe not take as many vacations. We can make do until the government announces that we have extended benefit programs that will extend out for nearly 2 years if you are actively looking for work. Of course I'm looking for work. Those programs have come to an end now, and you can see how that percentage has actually fallen off. But still, even today, let's say it's a fair number now that those programs have come to an end, it's still representing about a third of the pool of unemployed workers have been unemployed for more than 6 months. And then the other factor comes in terms of people who are considered employed, but are not being employed the way they would like to be employed. Those people working part-time for economic reasons. People who would like to be having a full-time job, but instead they're only able to find part-time work. That represents about 4.5% of our population, 4.75%. Historically, that's been closer to 3%. So that's another 1.5%, or another roughly 3 to 4 million workers who are not satisfied in their state of the labor market. And I'm not even touching upon all those individuals who are underemployed, college graduates who are taking jobs just to pay bills, just to keep themselves occupied, taking jobs they are overqualified for, which could be part of the problem with regard to some of the youth employment, that maybe some of those jobs might be filled by more skilled workers. So, point is, we are very far removed yet from talking about a labor market that will be in balance. The unemployment rate, in fact, for a blue chip, they're expecting to see that just edge lower from where we are by the end of next year, still being above 5.5%. The Fed sees about 5.5% by the end of next year, and about the natural rate by the end of 2016. So from the Fed standpoint, we're thinking we're going to probably have to wait about 2 more years before we could talk about the labor markets being much closer to where the slack has been removed. And that's going to, again, require growth that's close to 3% each of those years. And then even dipping below that rate, or slightly below that rate in 2017. So many of you have heard the fact that, inflation is, it's going to be starting to rise, that the Fed's been printing money like it's going out of style, and that's going to generate a lot of price pressure. I'll talk more about that at the very end. But the story that I'm telling you, and hopefully you understand from the demand side, things are growing, but not growing very much. All in all, it's a story of weakness, not strength. And it's not just in the U.S., but around the world. In fact, the IMF came up with a revised view of world economic growth, and it sent the market down, nearly 300 points a couple of days ago. So when you have too much of something, too many unused resources, too many workers looking for work, tends to put downward pressure on wages. And we've seen very poor performance on wage growth. When you have too many machinery sitting idle, it tends to cause prices in those sectors to go down. I mean, So when you have too much of something, it puts downward pressure on prices, not inflationary pressures on them. And in fact, when you look at what's happened on prices, they remain, all in all, very moderate, below the target that the Fed thinks about. And removing food and energy prices, you get a similar view. What's the outlook? Well, I like the blue chip to think about whether or not that story about, fine, inflation is low now, but just you wait, it's going to start to rise. I look at those green bars to see whether or not there's some kind of an escalating pattern, maybe by the end of 2015. 2015 fourth quarter is just as flat as any of the others there. And what the Fed sees, even with above trend growth for the next several years, that will be enough to begin to lift up the inflation path up to our target of 2%, but still not exceeding our target of 2%. One of the reasons why Charlie Evans, Fed president of Chicago, is more aggressive with regard to that, because it's our belief that if this is a target, it is not a ceiling, and that if we've been under it for as long as we have, there's nothing wrong with going above it for a while, especially if that would allow the labor markets to correct themselves more quickly. And removing food and energy prices, this is also showing a very similar trend, suggesting that there's no difference in food and energy prices. In fact, if you haven't been following it, oil prices are now well below $90 a barrel, about $85 and change. Why? I mean, we've got all this interesting stuff going on in the Middle East. Normally, somebody sneezes in the Middle East, and it sends oil prices skyrocketing. Why has it collapsed? Because of this very soft view of world economic growth. If you're not growing very rapidly, you don't need as much oil to do the business that you need to do. Manufacturing continues to do well. It's probably been our stellar sector during this recovery, growth rate that has averaged 4.7%. And we have, like in employment, we have fully recovered the losses, the more than 20% decline that took place. But it's productivity driven, because we've only brought back about 31% of the workers. So how do you get back 100% of the work, but only 31% of the workers? Doing things more effectively. And the firms that went out of business, there was a tremendous loss. Maybe many of you were dealing with some of these manufacturing companies that had to file bankruptcy. They probably weren't the most efficiently run. So the ones that survived grabbed their business, doing it more effectively, and the firms that we have operating are far more lean and mean today than ever before. We have world-class manufacturing in the United States, producing more in the U.S. than any other country in the world, by far. 24% of world manufacturing output in the United States. Only 5% of the world's population. China produces 16% on a evaluated basis. Outlook for industrial production continue to outperform its long-run trend, 4% and 3.4%. And for example, light vehicle sales continues to do very well. We're seeing pretty good growth rates there. We're back above pre-recession levels. Vehicles, the average age of a vehicle is 11 years of age, which is an amazing attribute and accomplishment for the automakers. 25 years ago, those of you who remember, you could not have a car 11 years old, let alone the average of 11 years old. They were not built that well. But to think that the average is today 11 years old is really something. And it's expected to continue to grow. But the growth rates are slowing. But as long as employment continues to rise as we expect, those individuals will need a more reliable vehicle than probably the one they have sitting in their driveway. So the last thing I want to close off with is to talk about monetary policy in light of this view that I've shared with you for the economy. Beginning in December of 2008, we basically took our primary policy tool, the overnight rate, the federal funds rate, down to, in essence, zero. We call it the ZLB, the zero lower bound. We wish we could have taken it lower. The Taylor rule, John Taylor from Stanford University, has a rule for monetary policy that suggested maybe -4, -5% we should have done. And we thought about it. And we thought about how we could do a minus 5% interest rate policy. It could be done. So it'd be like for every $100 that you have on deposit at your bank, next year you'll get back $95. Sounds like a good plan? What are you guys laughing at? What would you do if that was taking place, if we announced that today?
Use my mattress.
Yeah, you would see the withdrawals out of the financial system in a heartbeat. And it took you a couple of nanoseconds. It took us maybe a second or two, but we figured out that would be very, very disruptive and destructive to the economy. So you're laughing. I mean, why the Cypriots didn't figure that out a couple of years ago? I don't know. Or the IMF, who advised them to go ahead and put a tax on deposits, which is in essence the same thing as a negative interest rate. Anyway, so we've kept it down now since December of 2008. What is the outlook for policy? So what I'm doing here is I'm grabbing the midpoint for the 17 policymakers. And there's a diversity of view, and tomorrow I'm sure Jeff Lacker will share his view. I'll share Chicago's view with you in just a second. But this is the midpoint of the 17 policymakers who in September provided where they think interest rates should be, according to where they think is appropriate. And so they're expecting not much change by the end of this year, but by the end of next year, maybe a little more than 100 basis points increase. By the end of 2016, just shy of 3%. So we're still accommodative because the long-run view of where policy should be is about 3.75%, which is not achieved until the end of 2017. So at the end of 2017, we're finally up at the neutral rate for Fed policy. Up until that point, we are not putting the foot on the brakes of the economy. We're just taking our foot off the gas pedal of the accommodation of monetary policy. And in speaking at the Auto Finance Summit yesterday, I got this question about, isn't raising interest rates going to slow the economy? Isn't that going to put some headwinds to the economy? And certainly higher interest rates are not as favorable to borrowing or to buying something on the credit than lower ones, but at the same time, we're unusually low right now. The reason why we're bringing them up is because the economy's growth is improving, something that I think we all should be celebrating. The sooner we can return up to 3.75%, the sooner we can acknowledge the fact that the economy doesn't need the crutches that the Fed has been assisting it with over this time period. And certainly the other crutch that the Fed has been assisting, since we could not go below the zero lower bound, was buying assets, just basically pumping liquidity into the system. And our monetary base here, the assets that the Fed has been holding, has increased quite dramatically from about $800 billion. And by the way, all these shaded areas here, the non-blue, those were all the special programs that we put in place during the financial crisis to assist specific markets, using the special provisions that was established during the Great Depression that gave the Fed the ability, under exorbitant circumstances, to go and offer these policy tools. But they're all gone for the most part. Though they're basically, they don't exist, which means that the financial markets are far healthier today than ever before. Nonetheless, we have increased our holdings, QE1, QE2, and most recently QE3, which is predicted to end the purchasing of assets at the next meeting in December, or by December, I should say. With that in mind, the balance sheet, though, is very high, more than five-fold of what it was. And this is what gets people excited. And I've seen very smart, which makes me wonder either how smart they are or whether they're trying to use that lying with statistics argument, who will use this to talk about inflation's around the corner. In fact, Wall Street Journal editor was last year at a conference that I'm in fact heading off to this weekend. He spoke and got it wrong. And I went up to him afterwards and I'm like, I'll be speaking right after you. I'm going to I wish you'd stick around, but you know. And I told him why he got it wrong. But anyway, I didn't hear back from him. But he did stop the writing that he had been doing on this. So maybe I did have some impact, because Milton Friedman, Nobel Prize-winning economist here in Chicago, famously said, inflation always and everywhere is a monetary phenomena. You want to see what's going to happen to the price level, inflation in a country, just look what the Monetary Authority is doing with regard to its money supply. But it's the money supply you should be focusing on, not the monetary base. The monetary base, yes, is part of the money supply, but it's not the ultimate money supply. And people will say, well, who is the Fed even to be creating this money? Who gave them the authority? Well, first of all, Congress did. But second off, I want everybody in this room to hold up their hand at this moment. A little exercise for the afternoon, all right? You may put your hand down if you have, not yet. I'm telling a judge what to do. Is that great? You may put your hand down if you ever borrowed money for an auto loan, a student loan, mortgage, credit card loan. I don't see a single hand in the room up. You know, I can accuse each and every one of you of creating money. Who gave you the authority? Of course, every time you borrow from a financial institution, that creates money. Don't believe me? When you get back to the office, bring up your Money and Banking 101, Macroeconomics 101, look at that T-table with assets, liabilities, and you'll see that. And what we're seeing, though, is that the amount of money that the private sector, financial institutions, and other lenders create is factors larger than the monetary base, threefold. But what's been the problem during this downturn? Nobody's lending for the most part. It's been a real challenged environment. That's the headwind that the Fed has been facing. Now, I had a chance to, when I came out to Chicago, you heard 1982, I actually went to the other school, Northwestern University here. There's more than that. I didn't mean to. I teach at DePaul. They don't want to hear it. I teach it. But I took classes at Chicago as well. That being said, I didn't get a chance to meet Friedman. He'd already retired. And was writing working on his book and had come out with it at that point, Free to Choose and so forth. But I did have a chance to meet him when the university had a 90th birthday party celebration for him. And it was not your typical cake and candles kind of thing. Yeah, they had that at the very end, but it was an all-day seminar celebrating the work of Professor Friedman. And so they had different people presenting stuff, but the keynote speaker, I mean, the one person that was going to really talk about the work of Professor Friedman, especially the work that won him the Nobel Prize, which was the work on the Great Depression, financial markets in times of crises, was the professor who, after Friedman retired, stepped up and became the world's leading expert on the Great Depression, on financial markets in times of crises. Then this Princeton University professor flew in from Washington, because he had just left Princeton University to become one of the 7 governors for the Federal Reserve. This governor came to talk. And many of you, I already see you're nodding your head, you kind of recognize that that person was Ben Bernanke. And so at the end of it, where he talks about the failures of the Fed, he turns to Friedman and he tells Professor Friedman, says, you know, Milton, as a newly minted member of the Fed, I want to tell you, on behalf of the Fed, we're sorry. But we're not going to let it happen again, was his promise. So it's fascinating that, you know, Bernanke leaves the Fed, becomes the president's head of the Council of Economic Advisors, chairs that, and then when Greenspan retires, he's nominated to be the next chair of the Fed. And so you have the world's leading expert on the Great Depression. And I can tell you, when I was teaching Great Depression to my students before the financial crisis, the eyes would roll back in their head. Why are you teaching us this ancient history, old man? And, you know, now they pay attention because they realize that so here's what happened during the Great Depression. The Fed, yeah, we were increasing our monetary base, but not enough. Not enough to offset all the declines that were happening in the private sector. Why? Because of all the bank failures. And if banks create loans when they lend, banks destroy loans when they when they fail. And all the bank failures, without having FDIC protection, caused a calamity. And then look at the red line. Did the red line look what the Fed was doing, the blue line, and go higher? And, oh, look what the Fed is. No. Inflation always and everywhere is a monetary phenomenon. That's where it comes from. Certainly one key example. We had deflation during that period because we saw a collapse of the money supply. In fact, Friedman would refer to this period as the Great Contraction. He blamed the Fed for allowing the money supply to decline over this time period, worsening the situation. Well, under the Bernanke Fed, we weren't going to let that happen again, and he kept his word to Friedman. And we have seen the monetary base rise substantially, but look at the money supply. It's been rising not at 20-some-odd% as the monetary base has, but closer to around 6%. Something to think about with regard to nominal GDP growth. And look at CPI. It's tracking, if anything, the green line, but because of all this incredible slack that I'm talking about, it's not even tracking it all that closely. So the challenge that we're going to have is how do we adjust our monetary base so when lending comes in a more normalized fashion, do we not see that big amount of blue translate into a large increase in green? We're aware of that, and we have policy tools in place that we believe with great confidence that we'll be able to manage. So in sum, we're looking at an economy that will continue to grow. Not great growth, decent growth, but we're still probably a couple of years away. I mentioned, I was going to share with you the Chicago perspective. Charlie Evans believes that the economy's growth will still not be sufficiently enough to warrant raising interest rates even next year. At this point, he would prefer to hold off increasing it prematurely, in his view, until maybe sometime in 2016. So like I said, there's enough diversity of views, and you'll have a chance, for those of you who will be hearing Jeff Lacker, to hear the Atlanta Fed president's views tomorrow. Thank you very much, and if we have time for a question, a couple of questions. Thank you.
Classically, pumping out as much money as the Fed did would anticipate or create an asset bubble somewhere. Comments?
So the question is, normally when you put out this much liquidity out there, you would be creating asset bubbles. And I think there's something to be said about that. But we're not in a normal situation. The financial crisis is a situation where we had people who had over-leveraged themselves, and we're in the process of deleveraging. Has Fed policy encouraged greater risk-taking? Absolutely. So has it caused the stock market to perform as well as it has? Certainly, we've played a role in that. There's very limited tools that the Fed has available. The interest rate policy, certainly, and the money supply are some of those, but they're very blunt tools. But as you can see, as I tried to show, even with the improvement in the stock market, the question is it a bubble or not? It certainly has improved people's balance sheets, so people are feeling better with regard to their stocks. I might argue, did we just help it to return to levels that it might have or should have been before the crisis? So whether or not it's at a bubble, bubbles are very difficult things to discern. For example, some of you might recall the last chairman or second to last chairman, now we have Janet Yellen, Greenspan's famous irrational exuberance comment. And the market tanked that day when he said it. The next day it bounced back up, and then it collapsed during the dot-com bubble. That comment was made, I believe, in 95, 96, the irrational exuberance, December of one of those years. I'm already forgetting which one. But then we had a dot-com bubble in 2000 that collapsed. By the way, when this S&P fell, it never got down to that level where Greenspan was talking about irrational exuberance. So the ability of discerning if we have a bubble is very challenging. And if you try to pop something when it's not a bubble, what are you doing but causing the economy's growth to be worse than it otherwise would be? Yes, sir.
The gridlock in Washington, is that helping or hurting the economy?
Gridlock in Washington, helping and hurting the economy. I'm going to try to stay away from talking about anything about the fiscal side, but I think in part we have to think about that. Your question's a very good question, and certainly we think about whether the fiscal side is going to be a drag or stimulus with regard to the economy, so we can kind of gauge what that growth is. So that growth that we have in those forecasts from the Fed includes their view of fiscal policy. But whether or not a gridlock is good or bad in Washington, I'm just going to have to leave that one alone. Let me take one more, then we'll end it. Yeah.
The IMF and some others have been talking recently about the level of international debt internationally.
Yeah.
What's your view of what impact will that have on it?
So the question is, what about international debt and some of the concerns out there? Absolutely, I'm very, very concerned about, if anything, and we'll go to the bubbles thing as well. I'm actually, if you ask me where I see the risks out here, I see not as many risks in the U.S. I'm pretty comfortable. If anything, the auto subprime market is something we're paying a lot of attention to. In fact, we held some hearings in Washington at the Fed, bringing in a number of different consulting groups and others to study. When you scratch the surface and look behind all those, I'm still pretty comfortable, even with this hot area of subprime auto lending. Where I get concerned is the international sphere, and I tried to make that implied with some of the comments I was making about world growth. In particular, the excess amount of debt that is in Europe is very disconcerting. And especially, how they're going to adjust out of that. It's going to be challenging. I mean, certainly we have our own issues. You're in the Greece of the United States here in Illinois. Worst fiscal position of any other state in the country. And by the way, Chicago is the worst fiscal position of any city in the country outside of Detroit, and you all know where Detroit wound up. But I also worry about China because I think there's some real risk for imbalances there. And I think about that from the standpoint that there are capital controls in place restricting what people in China who are now making some money and their saving is quite strong, what they're doing with the money. And they don't have the ability of diversifying themselves by investing outside of China. So you've all heard about the number of apartments that people are building, these ghost cities that are going up. But also China has done a lot of industrial policy. I'm not a big fan of industrial policy where you get some smart person sitting in some government job making the decision of where something should be invested. I like the market to make those decisions where people look at profit and loss and figure out if something is good or not. And I think a large part of the Chinese economy is built on the former model. And I just begin to wonder whether or not a lot of those investments are really unprofitable. And, Warren Buffett has that famous expression that you don't know who's swimming naked until the tide goes out. And perhaps the slower growth that we're seeing in world markets as well as in the Chinese economy might all of a sudden force the hand of acknowledging some of these losing propositions that they have. And by the way, that would not be good for the United States. Many of you are aware that we import more from the United States than any other country. When we export, our two biggest export destinations should not be a surprise, Canada and Mexico. But in terms of beyond our NAFTA neighboring partners, the country we export more goods to than any other is China. So if China struggles, it's going to have a real direct impact with regard to U.S. growth. Thank you very much.